Let's talk about why technical analysis works, and it works very, very well most of the time, but not every time. And so we'll get into that a little bit and kind of the underlying concepts around technical analysis when you're looking at a security. And a lot of it gets back to that whole idea of supply and demand, right? If you have a lot of demand for something, the prices will rise up. If somebody really wants, a whole bunch of people are buying a certain product, for example, the person who sells that product could raise the price. Same thing with trading of a security. If there's a lot of demand for a security, the price will rise. And so what this leads with the supply and demand, it leads to predictable behaviors. If we start seeing certain patterns or certain things happening, we can anticipate that there's going to be changes or things that are going to happen that are as a result of that supply and demand. And it's been around a long time. I mean, it's been around since like the first time it was ever talked about in the book I read was in 1948. So it's not something that's like just brand new that's never been really proven or tested. It's been used for a very long time. In fact, some things like candlestick price patterns and all that have gone way back, hundreds and hundreds of years back in Japan. But certainly the term technical analysis, certainly since 1948, and many different things around that and proving why that works. But not all the time. So let's talk about what's the idea behind this. And one way to think about it is how people will travel together, or people will invest together, or traders will get an idea and they'll kind of start moving together, right? And that's kind of what we think about as trends, right? Think we're all kind of moving in the same direction. It's almost like a herd mentality, right? Okay, so I'm not going to say that people are like sheep. Okay, people are not sheep. Okay, but it's the idea of a number of people or animals traveling together, going in the same direction. So like if you look at this picture, for example, you could see that the sheep are traveling in a certain direction, right? They're headed downhill on a road, and it's nice and easy for them to walk down the road, and they're all kind of headed in that same direction for the most part. You can even consider that momentum investing, right? And we'll talk about momentum indicators, where they're all kind of headed in this easy trend going down the road. But you might also notice something that's going on that's a little different in the upper left. Do you see the little grass there on the left? And there's a few sheep who went on the grass that, hey, this looks pretty good over here. Let's go over here and have some grass. Now, they're not following the trend. Like if we were investors, we might say that this is a definite downward trend, right? Look at how everything's kind of moving down the hill, and it's easy to move down the hill. But we'd want to watch what's going on that hill over there, because that might be what we would call in technical analysis a breakout or a changing of the trend. And is it going to be a real breakout? Is it going to change the trend? Are the sheep going to change their direction and now go to the hill? So if we think of this as terms of a security, let's say prices have been falling, going down the hill, but now something's happening, something in the news or people are just for whatever reason are changing that supply and demand, and they're going to now go on the hill and the prices are going to start to rise. So if we have an indicator that says, oh, when certain things happen, people are going to start changing, the prices are going to start rising, kind of the idea of just like we see enough sheep that go up on the hill, the sheep will change direction too. So maybe it's a breakout, maybe a trend is forming, maybe it's just a retracement, which is another term for just a temporary move where it kind of goes up for a little bit and then comes back right away. It's a temporary move. So we're going to learn all about that. So that's the underlying idea of why it works, because it's looking at these big kind of macro type trends. Now it doesn't work every time because one, nothing's 100% perfect, of course. And then there's unexpected random events that can occur. And these random events could come at a company level. Let's say the CEO unexpectedly dies or gets fired or something happens. There's something that could happen at a company level, or they miss an earnings announcement unexpectedly, can drive prices up and down. But there are things that can happen at real big country or global levels too that are really beyond our control and even beyond our analysis, because something really unexpected happens. I mean, if we think about something that was really a big unexpected thing, or that had a certain shock to all the security markets for a time being, was like COVID-19. Remember back in 2020, we had COVID-19. And if we look at this chart here, if you go on the left, this represents prices. Amazon's in the blue for Amazon as a stock. And then we've got on here Norwegian Cruise Lines, right? So cruise ship, and we've got the S&P 500, like 500 large USA stocks to just compare them. And if you look to the left, you can see how the lines are together and how this represents prices. And so they're all kind of trending together as far as the prices. And then in February and March, becomes known that COVID is really going to be a problem, becomes a global pandemic and gets announced that way and governments start talking about it in that way. So it sends all the prices down, no matter how good a stock is or how good a security is, it sends everything down because there's this big unexpected event. Now, once the event happens, then things change or can change. You can see where people look at Amazon and say, whoa, wait a minute. In a pandemic where we can't get out and we're locked down and we need goods supplied to us to our home, maybe right directly to our door, where are you going to buy from? Amazon. This is good for Amazon. And as you can see, Amazon's price took off for the rest of the year from that. S&P 500 rebounded a little bit too, and actually finished the year up a little bit. But if you look at Norwegian Cruise Line, they went way down and hadn't recovered at least during the year of 2020. A little bit of recovery, but not a lot. Because again, this unexpected event had a bigger impact on them. I mean, who wants to be on a cruise line when you got a pandemic? And you remember the early stories about COVID-19, it was people trapped on cruise ships and they couldn't get home and COVID was raging. So you can see the impact that this unexpected event happens. So sometimes it happens, and you're going to learn about how we're going to put in built-in protections and things like that to limit our losses, like with stop loss orders and things we're going to learn about, and how we can recognize these trends so we can get out quickly to its technical analysis about buying at the right time, but also selling at the right time and avoiding big losses like that. So again, nothing is 100% foolproof, but having an exit strategy really helps. If you had no exit strategy with Norwegian Cruise Lines, you rode that way down, like I think it was down 70% or something like that. And if you're, like, say, a buy and hold investor, which is different than trading and certainly different than technical trading, you can suffer through that. And then you just don't get out. You don't get out soon. You try to ride out the storm. Now you see Norwegian go down so far. It's going to take a longer time to ride out that storm than, let's say, Amazon would. So, but with technical trading ideas, that I'm actually an active trader around that. So another thing with technical analysis too is it doesn't tell you how much to invest. It tells you with indicators and things whether you should invest and how, but it doesn't tell you how much. We'll talk a little bit about some money investment strategies at the very end of the course too to help you with that. But the actual indicators and things don't tell you like, oh, if I see this price bar or I see this moving average go like this, I should invest X number of whatever of my money. It doesn't tell you that. It just tells you what's happening, and then you decide what action you want to take on that. So technical analysis is terrific, been around a long time, works, but not perfect. Nothing's perfect, right? In the stock market world, there's different types of stocks out there. Some are big companies, some are small companies, some are technology or high growth companies, some are less growth, but maybe they pay you some income or dividend. There's different types of companies out there. But when it comes to analyzing companies, decide what to invest in or trade in, there's really two big schools of thought, and that is fundamentals or fundamental investing and technical analysis. So it's good to have a good understanding what's the difference between the two and where do you apply them in which situation. So if we think about fundamentals, that's where you're really looking at less frequent trading, and you're more looking at business fundamentals, right? You're looking at the company itself, the markets they're in, what competitive advantages they may have versus their competitors, what are they good at? A lot of times with fundamentals, you're going to look at ratios. If you've heard things like the price to earnings or PE ratio, or price to book, value investors look at that, price to book value, or PEG ratio, or dividend payout ratio, all these different ratios that are out there. That's fundamental analysis, really looking at, ratios of business performance, basically. And so it's fundamental analysis. Think about it, it's all about evaluating the business. And this is typically used by, let's say, longer term traders or longer term investors, where they're trying to look at a business and see how they might do over a longer period of time. And maybe they might be a less frequent in and out of a stock, typically, not exclusively, but typically. If we look at technical analysis, we're looking at organizations, we're looking at stocks, but we're really looking at, from more of a supply and demand standpoint, as far as what's happening with prices. Are prices going up and down, and what's impacting that? What's the market sentiment around that? What's driving these moves in the price? And we're looking at things like trends. Is there a certain trend? Is the price stock trending up, or is it trending down? That's where we use a lot of things like charts and all that, because we're trying to visually represent some of these things so we can see when should we buy, but also a very important technical analysis, when should we sell? So that in and out, that enter and exit strategy is very, very important for traders in order to make a profit. And so it's all about recognizing indicators and patterns. Think of indicators as like the tools. If this happens, then most likely this price is going to go, let's say, up, for example. So because I see this indicator, I'm going to invest here. Price goes up, I'm going to sell up here because my indicator might tell me to sell too. And then I make the profit between the two. Or I'm looking at a certain chart patterns and I see, like when we're looking at like candlesticks and things, I see certain things happening. I know I'm going to take action, either buy or sell action, or maybe I won't do anything based on this technical analysis. And that's, as far as looking at indicators and things along those nature. So if we look at an example how two people might look at this differently, one who's a very fundamental person, you can combine the two, but let's say someone who's very focused on fundamentals and somebody's focused on technical trading. Let's look at one stock as far as how somebody might approach it or talk about that stock. So let's say we have two investors, and the one stock we're going to talk about, let's say example Tesla, right? Electronic vehicles. So a person in fundamental investing would say why they might want to invest in it. They'd say, Tesla is the dominant market leader in the super growing area for the future, which is EV or electric vehicles. Even though their stock price is relatively high to their price earnings ratio, I think the future looks very bright and I want to buy now before the price goes up even further. A technical person, both also interested in buying the stock, might say, Tesla's price just went above its 50-day moving average. Plus Tesla is still near the channel bottom, so trends look good and I'm going to buy. So if you kind of break that down a little bit, you can see some of the words popping out. Let's look at this here, where the fundamental person is looking at growth, super growing area. They're going to use a ratio. More feelings, like I think the future looks bright. Where a technical person's not about feelings. They're about technical. They're about math and charts and market sentiment, those things. So the price is above its 50-day moving average, the average prices over the last 50 days. We're going to learn all about moving averages. Don't worry yet. And it's near the channel bottom, so it's near a bottom price, so they think the trend looks good, that it's going to rebound and go back up. So they're talking not about the business at all. They're talking about it as an individual stock opportunity to invest in and get in, and then maybe later get out when they change their mind. So a question might be, can you combine the two? Usually people who are fundamentals, they stay that way. Some people who are really technical stay that way. You can combine the two. I actually do combine the two too at times. And one way I would do that, or people do, is they might use fundamentals to narrow their choices of stocks. They might use some of these things as a screener, like a stock screener, to narrow down their choices. Or they narrow their universe down by, I'm looking at growth stocks, or I'm looking at stocks in the electric vehicle sector only, because I believe in that sector, that's more of a feeling or a belief. I believe in the sector of electric vehicles. And then they'll use technical type information to determine if now is the optimum time to buy, or maybe when to sell. So it's really a matter of a style and strategy too, and also a type of investor or trader you want to be. For example, a day trader would never really consider fundamentals. They're trying to get in and out of stocks in the same day. So they're not looking at long-term prospects. They're looking at short-term price movements to make a profit on. So the good news is with stocks, you can make money and be successful, whether it's with fundamentals or technical type of trading. Either way can be successful and might be more about your type of style and all that. And you can combine the two as well. Both have been proven to be very, very successful. One thing for technical analysis and technical analysis traders, we're really concerned about breakouts and retracements and understanding the difference between the two. And so if we look at that in this lesson, normally you have a trading range or a price range where you have a low price range or low price, and you have a high price, and the security will trade within that range over a period of time. And again, that period of time could be hours, days, months, whatever that period of time. But price will tend to stay in that range. And you might have some general trends within that range where it might be flat or kind of going sideways, or you might have a general uptrend, or you might have a general, let's say, downtrend, kind of within that range as stocks or securities constantly changed, throughout that time frame. But then things can happen, where it can break those general trends and start, reversing or going into a different trend. And is it truly happening, or is it more kind of like a fake and it's not really happening? And that's very important for us as technical traders to know when to help us when to buy and when to sell. So if we think about that, and conceptually, trends will continue until the pattern breaks, right? So something's got to break the pattern. And a lot of times what happens with breaking the pattern is something happens. There's some type of thing in the news, for example, an earnings announcement, something on a global scale, whatever it might be, or even just a rumor might, break the pattern. And that's what might be a breakout, right? It's going to break the pattern. Or it might be a retracement where it's really not a true breakout. And that's the idea, is something happens, there's some news or rumor, and then something's going to happen, right? So traders are either going to do nothing, but they might, let's say, start to really panic based on that news and sell real quickly and really panic. So, oh my gosh, this is terrible news. I got to get out fast. And so they kind of selling maybe quickly. The same thing if the news is great and there's some great announcements, they might have that fear of missing out, right? FOMO, right? They're like, wow, this is really taking off. I always thought it was really good security, but now it's really going. I got to get in fast and buy, right? So you have sellers and you have buyers, right? So that disruption is actually called a breakout, right? So that means something has changed and you've broken out of the new pattern. And there's either going to be a new uptrend, going up, or there's maybe going to be a new downtrend. And you might also have like a false breakout where it breaks out, but it's not really due to supply and demand or market sentiment or anything. There's something that's causing a short-term disruption into it. And that could be something like which relate to like position squaring by big players, right? Real big holders of things that might be adjusting their holdings in a particular security that's causing some disruption in the market versus some more legitimate news. So like if you think about what's some examples of this, kind of like big players doing a disruption that might be a false thing, not a true breakout. Now let me share a couple examples of things that are like that. So let's say you're a fund manager, a mutual fund manager, you own all the stuff in this mutual fund, millions and millions and tens, hundreds of millions of stuff. Let's say for an S&P 500 fund, and it's an index fund, and you have to buy more Tesla because they were just added to the index, which that happened not too long ago. So they're added to the index. They weren't in the index before, so now you just have to buy the stock because they were just added to the index. It's not because you think they're great, it's just you have to do it. So that's going to cause an unusual amount of buying, and that's going to change that breakout, because all of a sudden there's a buying for a reason beyond just, let's say, market sentiment. Or let's say Apple announces that it's going to buy its own stock back in a big purchase as part of a company stock buyback program. They're going to buy their own stock back. So that means they're coming in and they're actually buying stock on the open market. So if you think Apple's coming in to buy a whole bunch of stock, that's going to drive the price up, right? So that has, again, nothing to do with individual traders. It's a big player coming in being disruptive. Or let's say a fund manager of a big technology mutual fund wants to lock in gains before the end of the year because that's how they're evaluated. That's how they get their bonus, right? So they want to lock in a nice bonus. And they just had a big run up in Zoom stock, for example. So they want to sell a ton of their Zoom stock so they can lock in their gains for their annual performance and get a nice bonus. Does it say having to do whether Zoom is a good company or a bad company, or whether technical analysis says that we should buy or sell it? No, it's a fund manager has a big player who wants to get a bonus. So sometimes those things can happen. It's not often, by the way. It's not something you have to really worry about, but just understand that it's out there. And sometimes when you see movement and you see something like there's a big announcement that might be related to it, you want to say, okay, is this really happening? Or is this just going to be a short-term type thing and it's going to come back and pull back? In fact, we call that pullback retracements. And that's the breakout is where it breaks out and now is forming a new type of trend. Retracement is where it breaks out a little bit, but it's a minor move that's going against the trend and then it's going to come back, like that big player repositioning. So if traders think a current move has gone too far, they might have a little course correction or a little pullback, but then the trend might come back up again. As we learn through the indicators, we're going to learn how to spot breakouts and retracements and how to kind of use confirming things to see whether we're seeing a breakout or a retracement. Is it a true move or is it kind of a temporary type of false move? And sometimes you might see retracements, for example, where everyone has either bought or sold, right? There's an overbought situation where, everybody wanted to buy has already bought, so it's extended, so it's kind of have a natural kind of come back. Same thing if something's oversold. And we have these tools that can help us with that. One is the stochastic oscillator, which is a fun thing to say, and also will help us to identify things. And there's other tools and things we're going to be learning about that'll do us too. And a lot of times, another good way to look at it too, just early on, if you see volume rising, that bottom part of the chart, and you see volume rising where there's a lot of trading activity, but there's hardly any price movement, hardly any price increase, then the move is, whichever is happening, is probably ending. It's starting to stall out. So we think something's been rising, uptrend, for example, it's been going great, but now there's hardly anybody doing it now. It's really starting to slow down, stall out. Might be a time either for a temporary pullback or retracement, or maybe we might even have a breakout in the opposite direction, or it might go, backwards. So retracements, they can turn out to be actual trend reversals. It could be, it looks like a retracement, but really it actually is a breakout and you have a new trend, or it might be truly an actual retracement where it's just temporary and then it'll kind of go back to the way it was trending again too. All this very normal. And with the technical analysis that we're going to be using and using our indicators, we're going to be able to handle and deal with both breakouts and retracements and identify great opportunities to purchase and also identify times when we might need to sell and get out as well. It works both ways. Let's talk about some things that I think you'll find very interesting, but also really set you up for success in the course. And this lesson, we're going to talk about the universal language of technical analysis, how it can apply in many different contexts. I'm going to show you some free practice tools or explain how those work with paper trading and back testing that you're going to end up using a lot once you get through the course. And then also talk a little bit about trading platforms. So you get a lot of questions like, what's a good platform, or where can I find a platform that works for me so I can actually do this trading? We're going to talk about that at the end of this lesson. So great lesson to get started with. So let's get started. So first off, the universal language of technical analysis. And what that means is we can kind of speak the same language by using these same tools and indicators no matter where you're at or what type of security you're looking at, for example. So if we talk about language, of course, there's many different languages out there. Here's different ways that you can say hello. But in technical analysis, if we're going to talk about, let's say, a trend line forming, that's the same no matter what the language, which is very interesting and terrific, actually. So that's why, on a quick note on terminology, I'll use the term security because that'll refer to really any financial instrument that holds some type of monetary value and is traded on an exchange. So examples of securities under this definition are like stocks, cryptocurrency like Bitcoin and others like Ethereum, or foreign exchange currency trading or the Forex market, because these concepts are universally applicable no matter what you're looking at. Now governments may debate, like especially around things like Bitcoin, is that a security or whatever, but for our purposes, all these things definitely are. Is it worth some money? Can you trade it, and can you trade it publicly in an exchange? And all these things fit, and then all the tools that we're going to talk about apply not only to the stock market, but as you learn them, you can actually, if you want to trade other types of securities, you can apply what you learned into those other securities as well. And isn't that really kind of great or terrific? So if we look at, let's say, an example of something from the course, this is a candlestick. It's a price bar, represents price. Came from Japan, so a lot of times you might hear them referred to as Japanese candlesticks. But if you look at this is the exact same candlestick, the same way it would be represented in different countries like India, Australia, Mexico, USA, wherever, UK, Eurozone, no matter where you are, a candlestick is going to be the same as far as look and how you interpret it and how you would apply it. That's the same thing as we talked about earlier, where not only can you apply these concepts to the stock market, but you can apply in things like Bitcoin, Forex, gold, or precious metals that are traded, or commodities like pork bellies or something like that, or rice that might be traded. So concepts are universal. It's a universal language. So you only need to learn one language. So if we look at an example, here's a stock chart, and don't worry about this yet as far as understanding how to read it. The concept you want to take away is you don't know whether this chart is reflecting stocks or Bitcoin as an example, but the concepts of when to buy and when to sell will work no matter what. And once you learn how to read this type of chart, which you will in the course, you'll be able to apply that. So that's really terrific, isn't it? And the concepts will work on the securities also no matter what time frame they are as well. So in this example, this is from the same security, but it's different time frames. And because I'm like, one is a day time frame, one is a week, one is a month, one is more like 3 months, you can't tell which one is which without labeling the time frame, because the concepts, again, are universal. You don't have a special type of indicator or special look of a candlestick price bar, for example, in one time frame versus another. So again, very universally applicable. And if you look at the bottom left there, you can see something where I've drawn a blue trend line. We'll learn about drawing trend lines. And there's a concept called a shaven top, right? Where the top of that little candle is and have a real tall wick. That's called a shaven top, and you'll learn about that too. Again, universally applicable. On the far right, same thing. You have a shaven bottom. It's just the bottom is missing the wick. And then you have these things where they're very narrow kind of bodies of the candle, which are called dojis. Again, we're going to learn all about this stuff in the course. The key takeaway is it's very, very applicable no matter what you're looking to do. Okay, so that's great. But now you might be thinking too, like you're probably thinking early on, at some point you're going to say, as I go through the course, I'd like to try some of these ideas without risking any money. Can I do that? I really like to try it, but I don't want to risk money, especially when I'm on a learning curve and I want to learn and apply things before I risk a lot of my hard-earned money. Can I do that? And the great answer is yes, most definitely. There's two ways to do that, and that's called paper trading and back testing. So let's take a look at each of those and how they work. So paper trading is where you can basically trade for free. Almost all, I think, online broker sites will offer this for free with, in effect, fake money, whatever your currency is, whether it's dollars or euros or rupees. But an online broker site will offer this type of thing for free. So you want to look for if they're offering paper trading. And all it is you basically get the practice for free. It's with fake money. It's a safe space where you can learn the mechanics of placing trades and building a portfolio and trying different things that you might learn through the course. And you can kind of get real comfortable with it before you start actually testing with money. So you're test driving these new investment indicators or tools that we're going to learn about, strategies and order types, whether it's a market order or a limit order or a stop order, all these things you're going to learn in the course. You can try it all without risking any money. So really look forward to paper trading. In addition is back testing. Also, you can find a lot of them for free on online broker sites. And again, you're using fake money. And what that is it's looking backward. Let's say through the course, I'm going to teach you how to develop strategies and you're going to learn the tools. And you're going to use these things and you want to test it to see what the results would have been in the past. Would it have succeeded in the past? No guarantee that it succeed in the future, but if it succeeds in the past, there's a very good chance it will succeed in the future. And you can kind of see your results there as well too. So basically you can build it. You can then input into the back testing program or algorithm as part of the online broker. And then you pull real data from the past, from the broker site automatically, and you can see results. You can say, well, if I invested X number of rupees or dollars, and I put that in, and I used this strategy, and this would have occurred, let's say, at a certain period in the past with a certain security, what would have been my results? Would I have made money? Would I have lost money? So back testing gives you a chance to, again, try your strategies and things before you start actually implementing them with real money. You see how these kind of go together? Paper trading is kind of letting you get practice the mechanics and trying different things, and back testing is kind of proving your ideas and thoughts that you learn through the course. So they work good in concert together. And they're very similar, and they're designed to, basically practice what you learn in the course. Back test is looking at historical stuff. Paper trading is looking at the current type of market and how things would have looked at. And then the next step after you do back testing and paper trading would be live trading, which is really where you're now investing real money. Now you're an active trader, doing investments. So, and you might ask yourself, well, why would an online broker offer this type of powerful mechanisms for free? Why don't they charge for that? And some may, but the reason they do is they want you to be successful. I certainly want you to be successful, but they really want you to be successful because they want you to learn and use their system. They want you to trade real money eventually, and then they can charge fees against that trading. When you make a trade, some are no fee trades, and some trades, which might be a little bit more complex, again, we'll learn about them, they might charge you a small fee to conduct that trade. Either way, that's how the platform makes money. And the platform can't make money if you're not comfortable or happy with the platform. So it's like test driving a car, right? If you can test drive the platform through paper trading and back testing. So that's their incentive there. It's always good to sometimes see what everyone's incentive is. My only incentive is thank you for investing in the course, and all I care about is helping you become great at trading. That's all I'm focused on. Another thing is well, how do we choose these different types of online platforms to use? Is there some you could recommend or something of that nature? And really the first thing you want to do is make sure that the platform is governed by the laws of where you live and that uses the currency that you want. I mean, if you're in India, you want to be able to trade in rupees, for example, than as opposed to if you're in somewhere else where you're trading in yen or euros or whatever it might be. Easy way to do that, it's going to seem super easy, simple, I guess, is to do an internet search and just put in stock chart tools for, and then whatever country you want, or something like that, and you'll start seeing things to come up. So if we put in, for example, here, India, you could put USA, you could put anything. It would come up with the top things. You're going to usually find these two towards the top. You can see stockcharts.com and TradingView. There's indie versions of both of those. Those are the two real leaders out there, by the way. And TradingView trades multiple types of securities. I think StockCharts does too, but they're mostly stocks. But TradingView, you can trade, cryptocurrency as well as stocks and different things. So those are ways you want to find and then start your research based on that. You'll usually, when you do that too, start finding articles like the 18 best technical analysis software for stock trading in India, right? So you can then look at these articles and at least get lists of things that you can start evaluating. And as you go through the course and learn the tools, then you can kind of see, okay, what are they offering? What can they do? How does it look? How comfortable do I feel? So the same thing, you could put in like online stockbrokers, for example, to find an actual broker in the different, wherever you live, UK, USA, wherever, and they'll usually come up with different articles like, best UK trading platforms, or NerdWallet's best online brokers for stock trading in the United States. This happens to be USA. I'm not recommending any of them. It's up to you to kind of go dig a little deeper after you start learning stuff in the course and see what might be interesting to you. So if you're in, let's say, Thailand or Indonesia or wherever, you want to make sure that it supports what you're doing in your country, in your currency. So these are some great ways to set you up for success. So as you go through the course, then you can kind of start to, have this in the back of your mind, like I'm learning stuff and I feel comfortable and I can always, like, say, paper trade it or back test it if I really want to, start applying many of the things that we're going to learn. So a great way to set yourself up for success. So when you track your results, you've got all this data, as far as your trades, and can we use that in a way to kind of give ourselves like a grade, right? Or a measurable number that we can look at to see if we're improving or how well we're doing and how much we can expect to make on each trade. And you can, it's a very important measure, simple to calculate, called the expectancy ratio. And that's what we're going to talk about here. And your expectancy ratio is based on the set of indicators you're using. I mean, that's your trading indicator plan. So you're using that with your plan. And the whole goal of the expectancy ratio is you want to see how much you can expect to make on each trade. If you do 50 trades, you would know how much you would make on average on each of those 50 trades. Some of those trades are winners. Some of those trades might not have worked out as well. Either way, you're going to they'll go into a calculation, the expectancy ratio, so you can kind of get a feel for how well you're doing. And the expectancy ratio is simply looking at your average profit, how much you make per winning trade, times your winning trade percentage, right? How much percent of the time are you winning or profitable? And then you subtract out of that the average loss per losing trade. That's where your stop loss orders can help minimize that, times your losing trade percentage, right? So a pretty simple calculation. So if we looked at, let's say, you're using an indicator as an example. We'll call it indicator set 1 here. So this is your indicator you're using. It could be whatever combination of indicators. We're just going to call it your primary and secondary. Let's say there's a third as well. But that's your indicator set 1 that you're using and that you're really committed to. And let's say, again, whatever currency you use, just submit different numbers. I'm using dollars here. But let's say that your average profit per winning trade is $800. That's pretty good. That's okay. Times 35%. Your winning trade percentage is 35%. Well, that's not great, so you would love to be above 50%. So you can already see this might not be so good for us, but if we can minimize our losses, maybe it won't be so bad. And we do. Our losses are only $400. So our wins are $800, our losses are $400. So that's a good sign. Though we do have more losses in this indicator set we're using. 65%, again, it's going to add up to 100%. 65% is our losses. So you do the math and you see 280 minus 260 and you get $20. So what you can expect to make per trade is 20 units or $20. And you may say to yourself, well, that's not that great. I could do better. Maybe you're looking at that. So this is where you want to adjust your indicators, track those results, and then try a different set of indicators on that. So let's say we did that, and we now have indicator set number 2. We're not using number 1 anymore. We're trying a different set of indicators, and we're tracking it separately to see how well we're doing. We want to get to that expectancy ratio. How much can we expect to make per trade? So let's say in this case, we're using a different set of indicators. Maybe we're being a little more conservative on the profit side. And so we're making less profit per trade. We're making only $600 instead of that $800. But you see our winning percentage in this example went up significantly. Now we're at 55%. That's not knocking it out of the park, but that's pretty good. So we're above 50% at least. And then we're still minimizing our losses. In fact, we actually reduced our losses a little bit to $300 per trade, and our percentage is down in there too. So then you do the math. You can see 330 minus 135, and we come up to expectancy ratio of 195. Much, much better, right? Now we're making 195 per trade, and you can keep adjusting your indicator sets or keep tweaking this a little bit until you can get to, expectancy ratio that's working for you, and you can kind of repeat this over and over as the idea. But right now, let's say we're at 195. Thus, if I was to make 100 trades over, however time period, a month or 2 months, however often you trade, maybe a day, if you're, fast, doing lots of trades, you can expect to make, 19,500, right? So that's 100 times your expectancy ratio of 195, 19,500. Thus, when I get to 300 trades, I'm going to be at 58,500. So again, you're going to have some wins and you're going to have some losses. But when you look at the difference between them in calculating your expectancy ratio, then you can kind of see what your your potential profits would be and see if you're doing that. Now, you can make that number even better, of course. I mean, if you increase your win percentage, right, and you're winning more trades, or the amount per trade that you're putting in, especially on those winning trades, is higher, you can increase those amounts. Note, it goes the opposite way. If your loss percentage increases, or you decrease the amount committed per trade, then it would, it's all mathematical at this point as far as your expectancy ratio. And again, a reminder too, that if you like that and you say, I can do even better, and you change to a third indicator set, well, then everything changes. Now you need to start tracking separately under indicator set number 3. And let's say your indicator set number 3 does great. It does 250 expectancy ratio. Well, now you've got a new indicator set. But if you do your indicator set and you give enough time to show whether it's working or not, and it's doing less than that 195, well, then the smart move would be to go back to that indicator set number 2, as far as, certainly maximizing your profits around that. So hopefully you can see here how powerful it is to know your expectancy ratio. Your wins, your losses, your scorecard, and that every time you make a trade, even if you're not so sure about a trade, you can say, well, I expect to make this much per trade. I know I'll lose some. I know I'll win some that'll go well above, let's say, the 195 in our example. But in the end, I know, in using this example again, I know that if I use this indicators that I put together, my primary, my secondary, maybe some other ones with it, and I can expect to make, as an example, 195 per trade. Well, that's a powerful kind of confidence boost, but also it's a great money management way to say, am I on track or off track? Or if I start changing my indicators, what impact is that? So understanding your expectancy ratio, tracking your results, calculating expectancy ratio can be very, very powerful, and I would certainly encourage you to do it. Well, we know we need to use stop losses. Now, let's talk about the different ways you can kind of set them up, the different types, and there might be a certain type that maybe calls to you or say, oh, that makes sense to me, that's how I want to use my stop loss order. So there's different approaches to how to execute it. And they're all really related as far as, again, trying to minimize losses and maybe even maximize profits would be the alternate way of looking at that. And so they're related, so you could be using setting your stop losses based off indicators about the money you have invested for a particular trade, or the timing. You might want to set a time frame as far as when the stop loss gets executed. And the thing is, though, they're related. They don't always match up, right? They all serve their own individual purposes. And so you want to choose an approach that works for you. And if you find one approach isn't working, or it's not working as well as you want it to, just adjust it, within that, type of stop loss. Just adjust maybe, how, let's say if you're looking at time, maybe you're adjusting your time periods longer or shorter, for example, or try one of the other approaches that we're going to learn about here. So you can always make adjustments to it, but you'll want to start thinking about it and start picking about one type of stop loss that seems interesting to you. They're all very valid, they all are used, and they're all, very good in their own ways. So let's take a look at these. A famous stop loss rule is the 2% stop loss rule, and it was popularized in the book The Way of the Turtle by Curtis Faith. Looked at taking amateurs and teaching them how to trade and using some rules around that. So if you're interested in that, Way of the Turtle is a very interesting book. And the idea of the 2% rule is you set a stop loss, or you stop a loss when it reaches 2% of your starting equity. Think of your equity as your money. What do you have totally available to trade, right? So it could also be termed like your trading equity or your investment capital. Basically, it's the amount of money in total that you've set aside for trading into a whole bunch of different trades. So for example, let's say you have 10,000 units. It could be dollars, rupees, whatever your currency is. You have 10,000 starting equity. So 2% of that would be 200. So that's saying under the 2% stop loss rule, you can afford to lose and would set your stop loss at 200 on each trade, right? So it's a 2% rule around that as far as your total equity. Now you might say to yourself, well, 200 out of 10,000 doesn't sound like much. Well, that also depends on how frequently you're trading, right? So it doesn't sound like much, but if you're trading many securities over short time frames, it can really add up fast, right? I mean, so it's a real fast way that you can really kind of go through your equity if you don't, put in some stop losses around it. And so that's where this 2% stop loss rule came from, the book The Way of the Turtle. And you can probably see that this is a money stop, right? So I'm using my stop based not on an indicator or anything. I'm just using like, hey, if I make a trade, I'm willing to lose 200. That's it. After that, I'm out no matter what. Another type of money stop is what's called a risk-reward ratio. And it's really the relationship of your expected gain versus your expected loss. So the higher the risk-reward ratio, the more desirable the trade is, right? So that's the idea about that. And then you can use your stop losses around how risky, let's say, a particular risk-reward ratio might be. So let's look at this as an example. So for example, let's say you have a security that's at 50, right? So you have a security that's at 50, and the indicators say the potential gain is to a price of 75, right? You're looking at your indicators, you're looking at where it might go. Indicators are saying, okay, or you feel you might make 75, or get to the price will get to 75, so you'd make 25, right? So you'd make 25. So you'd set your stop at a percentage below that initial price. So let's say you're willing to lose 20%, right? So you're willing to lose 20% on each individual security trade, which would be, in this case, so you're not looking at overall equity, you're looking at individual trade, which maybe will have different amounts. So in this one, it'd be, I'm willing to lose $10 or 10 units, right? So I'm looking at that, buying a security at 50, 20% of 50 is 10, right? So that's when I'm setting my stop below that. So if I'm buying at 50, my stop loss would be set at 40, right? 50 minus 10, the amount I'm willing to lose. It's a percentage of the initial price. In essence, I'm willing to lose 10 in order to make 25, right? You see that, how I'm thinking I'm going to get up to 25. My indicators are showing that. Maybe there's a trading range that's kind of established that might show that, and I'm at the bottom of the range or near the bottom. And I'm saying, okay, I'm willing to invest 10 to lose 25. So the ratio in a risk-reward ratio is thus for a $25 or 25 unit reward for $10 at risk, or 2.5 to 1, right? So if it was at, let's say, $40 in reward to $10 in risk, that would be 4 to 1, right? All right, so now you actually, now if you look closely, you might be saying, wait, that's actually backwards. It should be called the reward risk ratio, right? Because the first number is your reward number. I think because terms of risk reward is used in many areas outside of trading as well. That's why they use risk reward. But technically, you're correct. It should really be called the risk reward risk ratio. Nobody calls it that. They all call it the risk reward. So with this type of ratio, you want to be conservative a little bit in using this type of ratio and emphasize, the downside risk more, right? If anything, you might want to say, okay, I'm not as willing to lose as much, especially getting started with it. So you might want to, make those numbers a little bit, play around with them. There's different things. You could go higher, you could go lower than 20%. That's a big drop. Maybe 5% would be the right number. Those are all okay. Or you kind of use it the way of the turtle a little bit. You're looking at 2% equity. And the thing you can see from this, it can be a little complex to calculate, right? So you have to kind of factor that in. But if my risk to reward ratio, or reward to risk, is a higher number, that means I've got higher potential gain. So maybe I'm willing to take a little bigger loss because the rewards are much higher, or maybe I'm willing to invest a little bit more money because the rewards are higher too in comparison to the risk. So this is a way you're setting in the stop. You're still buying with the whole idea you want to hit that target profit. You still want to, every trade to be profitable, of course. This is just a way to minimize downside risk, and how much you want to have for that downside risk, you set as far as a percentage they'll fall below that initial buying price. Maximum adverse excursion, or MAE, is a timing stop. You think about timing. And a lot of times trading software will just kind of show you a graphic like the one we have below, where it kind of shows you where these MAEs are. And basically, it's what it is, it's a worst case loss that can occur over a trade's time frame. That's why it's a timing stop. So the software or the platform will do the calculation, but the idea is you're calculating the biggest change in the high-low range over a fixed period. Let's say like 20 days. It could be 20 minutes if you're a day trader, whatever your time frame is. That matches, the idea is you want it to be a fixed period that matches your typical holding period. So you get results back from, this is where back testing can really help on your trading platform, to try these different time frames and see how that would work for you, and using the provided indicators of this MAE. And you use a percentage or fixed amount to set the stop loss around that when you're playing around with the platform again. And the opposite of that, by the way, is a maximum favorable excursion, or MFE, which you can actually use for profit taking targets, right? So when you'll see a graphic, let's say on the platform, you'll see a graph like this where it's going to kind of show these ranges, and you can see that the lowest of this time frame, whatever that time frame is, that's your total time frame you're seeing as an image. The lowest low of that's your MAE, and the highest high would be the MFE. And so if you look at that lowest low, you could use a percentage of loss, like we were talking about, like these other ones, 2%, 20%, whatever it is, or a fixed amount, whether it was $200 or 200 units, whatever, and you can set it based around that. And you'd look at that kind of that center line. You'd look at when you're buying, and then you would set based on this kind of indicator or this tool that your trading platform will provide you with it. So look for, if you're interested in that type of timing thing, look under your trading platform for more details on how it, and the main thing is you want to establish the range you want to look at and have the range match up. If your range doesn't match up, then you might be a little bit too aggressive or not aggressive enough, depending on your time frame. So you want to look at that as far as the time frames that you've been trading on and that you're comfortable with. Another type of money stop that's really, really popular and really used, a lot more, I think, than even MAE, is trailing stops. And this is a great idea. I mean, the idea is that you raise the stop loss price as you make profits, right? So you have your initial stop loss when you first buy, because you always are going to set a stop loss. But then as it starts to rise, it's working out, your analysis has worked, and the price is rising and the trend is established and it's going up, you're going to start a stop loss along the way. So basically what you're doing is you can do it on a percentage basis or a fixed amount, percent or a dollar or rupee or whatever type of currency amount. How frequently you're updated, that's up to you. It could be daily, it could be more frequently, it could be less frequently. But the idea is that you're updating your stop loss to capture some profit. And let's say you want to set it as a percentage. Like maybe you say, well, I want to keep raising my stop loss to cover 80% of the previous day's gain, right? So it's going up, and now each day that it goes up and you're in a nice upward trend, maybe I'm adjusting my stop loss upwards, so I'm always capturing at least 80% of the previous day. And if it goes like that over several days, you can see how I'm really capturing a lot of profit all along the way while still giving me the safety net of a stop loss. But I don't have my stop loss all the way to the bottom when my initial thing, waiting for it to go all the way back down. I want to capture some of that profit. And that's where a trailing stop helps you. The key is to keep the stops updated to protect those gains and guard against losses at the same time. So that's why it's nice. It's kind of works in concert with targets as well. So the benefit of all that is it's highly protective, right? You're not waiting for it to go all the way up and all the way down. You're going along with it as it goes up, so it's highly protective and you're locking in those gains. The downside is there's some frequent updating might take time. It depends on how often you're trading, how many securities you're trading. If you're trading in lots of securities and you have many of them in play all at the same time, it takes time to check them and update them. And also some random noise activity can activate your stop and get you out before you want. So if you're capturing, let's say 80% of the previous day's gain, that's pretty good because that would be a 20% downward move. You've already locked in a lot of gain, but maybe you want to make that a little bit less of that. But let's say I'm setting my stop limits at, let's say 2%, a 2% drop. Well, 2% or 98% of the gain. Well, then I'm looking at maybe where it might drop 2.5%, 3%, and my stop loss is activated, as in I sell the security automatically and locking in those gains, which is a good thing. But then the downside of that is, maybe that wasn't really an event, and maybe I missed out because now it went back up as far as the profit. So you can adjust that as far as covering those, putting those trailing stops in and then just adjusting it either on a percentage basis or a fixed amount. The last 3-day rule is an indicator-based stop, right? So we're going to use our tools here. So it's very basic, but it really works. I mean, it follows along the lines of your indicators and market sentiment as well. And so the idea that if your analysis works, right, you've done all this hard work to identify a trend, you should start seeing some profit right away, right? It might go down a little bit, things move a little bit, but the idea is you're identifying a great opportunity to buy in as far as on this trend. And if you're wrong, let's say it's not the great time, or it just doesn't work out, then you have time to get out quickly too. So you could set something like around an indicator that's also around a little bit timing too. Is you could say something like you would exit if the price passes the lowest low of the last 3 days, right? So an uptrend would be a series of higher highs and higher lows, And if that doesn't seem to be happening and it really starts to kind of turn the other way, you can get out real quick in a 3-day rule or whatever your time period is, but typically it's a 3-day rule, that if it passes the lowest low of the last 3 days, that's the time to get out. Not just because it went down a little bit, but it's past the lowest low of the 3 days, and that's constantly kind of moving forward along that. So you're looking at your indicators as far as highs and lows, and you're using 3 days, so it's a little bit of a combination with a timing indicator as well. Another indicator, another stop that's out there, as far as the last one to really kind of look at here, is a pattern stop. And this is an indicator-based stop. And this is where you're trading off of your indicators. You're trading off indicator patterns. So some patterns will tell you where to put your stops, right? You're approaching either a support or resistance line, and you're looking for that, and you're seeing if it's breaking through. Let's say like a support line as an example, and it's going to keep going downward, not bouncing off that support line and go back up. So it's like using, and you can use it for profit targets. We talked a little bit about that too, but it's really just the opposite. So you'd really be looking at, like where you have a channel of some sort at those support lines. If you bought something and you're going to set a stop loss maybe at or maybe a little bit below the support line. That way, if at some point, if something happens that breaks through the support line, you're selling, then locking in some profits. Or you could do it, where you get more up towards a resistance line, and maybe halfway through you just want to get out because you don't even want to approach. You think it's hit the support line too many times. Maybe you want to put it in more towards the middle and get out a little bit sooner. So this is so this is an idea where you're using your indicator to kind of tell you where to put your stop loss and really buying your, and making your trading decisions. So let's say in the example, let's say you look on the far left there, let's say you buy near a support level and you're anticipating a price rise. Let's say we're at the far left of this example chart here. And you would put a stop loss below the support price. You bought at support, maybe a little bit higher than that, and at the support level, so you put your stop loss below the support price line in case there's a downward trend, all of a sudden breaks through that level. Something happens, there's a big event, something unexpected, and it breaks through that level. So there you've protected yourself against those losses. And then as it rises up, then maybe you want to, sell as it approaches the resistance level, and then repeat it over and over again. But you can see this one, this is an example where it goes up to a nice resistance level, but then comes down, but doesn't get all the way to the support level at first. It does after a second trend or a second rise up, kind of where that middle arrow is. And so you're kind of watching that as far as maybe I would raise up my stop loss and make it more of a limit where I might go a little bit higher above the support level, or maybe I go a little higher than that even to lock in profits. So you have to kind of look at that as far as how you want to do it. But the idea is that you're using an indicator of some sort that's going to tell you that when this indicator condition happens, that's a sell signal, and I'm going to sell on that. And you need to kind of watch for that as far as when you establish your trades. But you're already kind of have that in there, and you've set a stop loss based on that indicator at the time of buying. That's the key. Again, you're always doing it at the time of buying to minimize those losses and hopefully maximize those profits. So stop losses, very, very important. Do it. It's going to really help you become a more successful trader for sure. Because really where people get in trouble with trading is they don't have stop losses. All of a sudden something happens and it drops real dramatically in price, 10% down, 15% down in a very short period of time, within minutes or hours sometimes. And all of a sudden, boy, now you've set yourself up for a losing proposition. And that's where if a stop loss on place, where a lot of traders will be like in denial, like, oh gosh, you went down so far, 15%, it's got to come up some. And maybe it does, maybe it doesn't, maybe it trades sideways for quite a time. Either way, you're more like locking in losses at that point. As opposed to profits, you're locking in a loss. So having a stop loss, kind of takes you out of those trades that maybe just don't work out. So when you have your great trades that are going to hit these target prices and really have these nice profit runs, you're going to do great with those and minimize losses on the ones that maybe don't work out as perfectly as you would have hoped. Successful traders track their results. Tracking results is very important. It's your scorecard. It tells whether you're winning or losing. Otherwise, you're just doing lots of orders and all that. That's fine, but you really want to know, am I succeeding or not succeeding, right? So tracking results is your scorecard. Are you winning more trades or losing more trades? What's your win percentage? What are your profitable trade percentage versus, let's say, the losses you have? What's your loss percentage? And looking at actual money amounts, because in the end, it's what we take home as far as our profits that really matters. So you want to look at your actual money amounts. And one thing when you're tracking results, and we're going to share some ideas around this, is to give enough time for the number of trades that be valid. Think about it like statistical validity around that. And there's no hard rule number about that. You'll kind of get a feel after you do some trades as far as, okay, I've done whatever 30 trades like this and I've lost every one. Well, then you might want to change that concept that you're using, for example. That's really extreme. That wouldn't happen. But you don't want to like trade something twice and find out it didn't work and say, oh, I'm just going to have to change my whole approach. Give it enough time that you feel comfortable that you've given it a fair shot as far as a trading idea or strategy or the combination of indicators you're using, your primary and your secondary and the third one, and how you're using them. Give it enough time to show that there's some validity around that. Now, what you want to do is you do want to track every trade, right? That's what gives you data, right? Some of the most successful companies, what they're good at is managing data, big data. We've heard about big data, for example. So you want to have small data, I guess, or big data to you as far as knowing your data, knowing your results. So you want to track every trade. It can be simply just on a spreadsheet or whatever. So you want to track every trade. You do want to, if you have an outlier trade, something that's outside of your normal trading norm, right? So maybe you have a primary and a secondary that you use as far as your indicators and tools, and maybe there's a third one you use to, in some way, that's or fourth or whatever it might be. But let's say sometimes there's an unexpected opportunity where you want to try something that's outside of your norm and to see how that goes and all that. That's fine. Just track that separately because that should not, impact your normal trading pattern when you have an outlier out there that you're experimenting with or trying, or you just think you just see this tremendous opportunity. And what this will all lead to is a calculation where you can kind of measure your performance. And that's what we talk about in the next lesson around the expectancy ratio. How much can you expect to make per trade? So stop loss, just in the name, sounds good, doesn't it? It's going to hopefully reduce our stop losses, which we want, right? So let's figure out, well, what is this really all about and how do we use it? So a stop loss is actually a trading order, an order that you place. So really the definition of it is an order you put in place with your broker, your online broker typically, to automatically exit a trade if it goes against you by a certain amount. So let's think through that a little bit here. So you've bought something and at the same time you're going to put in a stop loss that at a certain level, if the trade goes against you, it starts going down in price, you'll automatically sell at that point. And you can determine, how far down you want to do that. And we have a lesson on that as far as how to actually set these things. But basically you're thinking about, it's an automatic exit of a trade that you're setting up ahead of time. So the stop loss you input is an amount below the current market price. What people are buying at, what you might be buying at, especially if you're putting in a market order where you're buying at market price, for example. And you place at the same time you place your buy order. So at the same time you're buying, you're putting in a stop loss that only gets executed and automatically if certain conditions are met. And why are you doing this? It's part of the overall plan, right? It's part of the plan to minimize losses, is what it is. Because sometimes these things can turn on you quickly, and so you want to have something that's automated that can help you with that and really lock in either profits, if you've got a lot of profit off a trade, and you want to kind of lock those in a little bit with a stop loss order, or to minimize losses right off the get-go. But you're placing at the same time that you place your buy order. So if we look at this graphic here, it's from Financial Express, kind of a nice graphic. You can see where the person's watching a trend on the left there that's going downward, but then it turns around and he's looking at a place where he's first pointing like, okay, that's where I want to really kind of make sure, I think that's going to settle, and I want to stop my losses there. And then he buys, right? So he waits for the trend to develop, and that's a good thing, waiting for the security and the trend. The trend is your friend to develop, and is buying there. And then is placing a stop loss order at that point just below the buy order. So the idea is if he buys there and it goes down pretty quickly, he's going to minimize the losses by having that stop loss order in. As it turns out in this graphic, the order keeps going up, the security keeps going up in the green there. And then if he leaves that stop loss order in place, it would come back down. And let's say if the person hasn't sold by the time on the far right there, then the stop loss order would be automatically executed. And you'd still have a loss in this example. So really what you'd want to do, and you can do, is you can actually move your stop losses as you make more profits. Or as you have other rules and things around that once you reach your certain targets as far as profit maximization target, you might have sold before your stop loss order is executed. Or you adjust your stop loss order upwards, which you can do. We'll talk about that a little bit later, but you can adjust that upwards so that your stop loss moves kind of with as your security moves up in price too. So you're locking in some profits that way. And when we get into the market order type section, well, there's another thing called a stop limit order, very similar to stop loss, and we'll get into that at that point here later. We have a whole section just on how to trade securities on the different types of orders, from market orders to short to stop loss, stop limit, all that kind of stuff. So we'll be learning about that. But the key thing you want to take away from here now is that I'm able to minimize my losses on at the front end, but I can also adjust it to maximize my profits on the back end by adjusting the stop loss order up. So you might have some questions. There are some frequently asked questions or FAQs around stop loss orders. So first, a common question is, how often should I use a stop loss? You should really use it every time. I mean, every time. The whole idea of trading is you're trying to make profits and all that, and you don't want to have your losses go down on something unexpected happen, have your losses all of a sudden go way through the floor right after you buy something. So putting in a stop loss, even if it's never executed, is always a good idea. You should really use it every time. The exception on that might be a buy and hold, or a long time hold investor. Somebody's holding for a year or more, then they might want to, their whole idea is that they're going to go through long down periods and have that security come back up, is the idea, by basically using time on their side. But if we're actively trading, we don't have that kind of time. We don't want to hold something for 2-3 years if you're an active trader. But a buy and hold person could get away with not using a stop loss. But if you're an active trader, no, use it every time. Do I have to use it? Can I just sell when I feel like it? Just have a feeling, or use something like an indicator and just feel like it, and have it not be automatic. And the answer is yes, you have to use it. You have to use it every time, and yes, you have to use it. And the reason for that is the stop loss, putting that in place, takes emotion out of it. Sometimes we get attached to a security, we're in denial, we think it's going to come back, and it doesn't, and then we sell at a deeper loss than we maybe wanted to or intended to. And then we figure out that even though we've had some profitable trades, we've had some real bad stinker trades because we didn't put a stop loss in place. It takes timing out of it, right? It's time to always, it takes the timing as far as time you spend always watching it. Because it's automated, you don't have to be watching your security constantly all day long during the trading day. You can just put the stop loss in there, and then you can adjust it later as, let's say, if hopefully you're riding the trend and you're banking in some big profits, you can adjust upwards at that point. And it helps you to exit out fast out of fast big drops, right? Where something unexpected happens and all of a sudden the security is really dropping in price. You're not watching it constantly. It's hard to do that. So so the stop loss will just automatically take care of that order and sell, and either minimize your losses or lock in a gain. And again, it's all part of your plan, right? It's all part of the plan, the trading plan that you have. And lastly, a frequently asked question is, I'm worried that my stops will keep getting exercised all the time, particularly in a volatile market where there might be whipsaws and things where it's up and down, and they're always being executed. And my trade never really has much, time to really develop. And that's okay. That can happen. Just adjust your stop levels to account for that. Maybe you need to set a deeper loss level and be comfortable with that. And in a trading a very volatile security. If you find you're not comfortable with that, then you might want to look at securities that are less volatile in terms of going up and down, and maybe take a look at that trading indicator section around volatility. Again, this would be a good time to review that if you're still wondering about where you might fit with that.